Welcome to the lecture on risk premium and portfolio return and risk. So, in this lecture we are going to have the discussion about risk premium, risk aversion basically, also that many a times the investors wish is that to avert the risk. So, risk aversion refers to avoiding risky situations. Most investors are risk averse, that is they choose the less risky investment. So, basically many a times or most of the time when you ask the investor, he would try to tell you that he will go for the less risky investment. So, in the less risky investment the return will be less, investment amount will be more, return will be more less, whereas in the more risky situations the situation will be opposite. So, the tendency comes with the understanding that the returns expected from less risky investment would not be high, certainly that is the one, but then people do not want to take risk, there is a tendency of risk aversion. So, that is why they go for the less risky options. It can be said that a primary implication of the risk aversion dictates that higher security, the higher a security risk, the higher its expected return and low its price. So, that is normally the what can be said, and many a times the difference in the rates of return for the two investments because of the change in prices due to changes in demand, that is not known as the risk premium. So, we will be talking about this risk premium. In fact, we can try to understand, suppose there are two investment opportunities, and let us say one is A and one is B. These are the investment opportunities. So, and A is said to be riskier. So, A is riskier than B. So, more risky and this is less risky. Now, in that case so basically what happens, that suppose we started with A and B and they are giving you the same return. So, suppose on the share price of 80 rupees, each one of A and B is giving you the return of 8. So, that is your 10%. So, suppose it started like this, that A is also giving 8 for 80 rupees and B also is giving 8 for 80 rupees. Now, the thing is that with time, if A is said to be more risky, in that case B people try to prefer invest in more numbers in B. So, people will queue for B and more number of investments will be there, and in that case there will be demand for B and B's share price will go up. So, with time with time the price of A and B will be changing and B will be more than 80. So, it will be going as suppose 100, and A, since its demand has gone down, so its price basically is coming down to 60. Now, if you look at in that case the return still is the same. This is giving the return of 8 at a price of 100 and this is giving a return of 8 at a price of 60. So, if you take the rate of return, do the rate of return analysis, what you see that you have rate of return will be less for B than that for A. So, our rate of return will be 8 for 100 and this will be 8 for 60. So, basically this will be about 13.3%, and if you look at its rate of return, it will be only 8%. So, what you see that this rate of return has there is a rate of return that is decreasing in the case of those in such cases where you have this is the more less risky option, you have the rate of return as the smaller one than the the option which has the more risk. So, the difference, this is a difference of 13.3 minus 8, that is 5.3%. Now, this is because of the change in prices of these two, because of the risk aversion notion, there was change in price between them, and because of that this is the change in the rate of return, that is 5.3%. This is known as the risk premium. So, because of the risk aversion, people try to go run after those opportunities which are assumed to be less risky, and in that case the higher rate and the margin of rate of return which you get in such cases, that will be known as the risk premium. So, that is the case of risk premium. Now, we will talk about the return and risk at the portfolio level. Now, what happens that many a times we have talked about the single situations where people purchase and they are investing, but many a times we are not going to address single asset in isolation. Now, these financial assets and investment opportunities, normally they are often discussed in a group and managed in a financial portfolio. So, all these corporate investment businesses, funds, bank accounts, and then insurance and pension funds, and they are or individual investments, they are all held in portfolio that are most likely to be diversified. So, basically you have there are many things grouped together and then they are managed. Now, you will have the return or risk of the entire portfolio. It is not because of the single entity, a single asset. So, it has single component will have certain bearing on that, it will be doing that. So, this will be becoming important because it will have the impact, but then you cannot say that by one you can tell that either it is you are losing or you are gaining or so. So, it will have its impact because they will be having their individual impact, and how that impact is assessed that we can understand. So, if you can look at that situation. Now, what happens that in most of the cases when we talk about the portfolio return. So, when we talk about the portfolio return. So, basically the portfolio means you have a number of individual assets. So, portfolio means you have a number of individual assets and each in a different proportion. So, each in a different proportion. Now, when we try to find the market value of the entire portfolio, that is VP. So, that is market value of the portfolio or entire portfolio. This will be the summation of the values of the individual assets. So, you have many assets combined together, it will make a portfolio, and the value will be the summation of all these individual values. So, it will be V1 plus V2. So, this will be going up to, suppose you have n assets. So, you will have VP will be value of the portfolio will be V1. So, that will be entire portfolio. So, VP is the value of entire portfolio. So, this will be V1 plus V2. So, that will be plus V n. Now, each asset which is V 1 or V 2 or so, it has its own proportion. So, this proportion or it will be talked as its weight. So, individual weight. So, this weight W I, that is your individual weight. Now, this will be basically its proportion divided by the total value. So, individual weight, that will be its ratio of the ith assets value and divided by the value of the entire portfolio, that is V p. So, that will be your V p, and you have I varying from 1 to n. So, you have n different weights defined. Now, what happens that if you sum all these weights, so that will be coming to 100%. So, that will be coming like that. Now, what happens that you can find the rate of return in that case, and all these returns on all these individual assets, they are going to contribute to the return, overall return basically. So, the return will be return of the portfolio R p, that is return of portfolio. So, it will be summation of the individual returns. So, that will be R 1 plus R 2 plus R n, and the R p, as you know, R p will be basically the R 1 W 1 plus R 2 W 2 plus this way it will go, and it will be R n W n. So, what happens that if you try to see that altogether you will have altogether you can define this R p as summation of I equal to 1 to n, then you have R I and W I. So, this summation altogether it will be talking about the return of portfolio, and you have summation is R I W I. So, it is the if you talk about the portfolio return, it is the summation of weighted individual returns. So, that is your R I W I of its all component assets, and the weights proportion we can find, as you know, that depending upon the value of the assets. So, this way portfolio return is calculated. Now, we can have one example, like we can see that suppose one investor. So, if suppose you see that one investor's portfolio is there and it contains two different stocks. So, investors portfolio contains two different stocks. So, two different stocks are there, then it has two different mutual fund is there, and also it has two different bonds are there. So, it has 6 assets, and among them you have to calculate the portfolio return, and its values are given. Suppose you have asset, and for that you have two different stocks. So, you have S 1 and S 2. Similarly, you have two different bonds. So, this will have B 1 and B 2, and similarly you have two different mutual funds, that is M 1 and M 2. Now, in that case the return which is given. So, for that basically you have the data given, and its weight suppose is given as R. So, that is your R I, and similarly you will have values of W I, that is weight percent, and then you will find the R I and W I, and then you will find the summation of R I W I, and that will be giving you the value of the portfolio return. So, you will be given their individual weights, and suppose their individual weights are given as 23, 18, 15, 15 and 17 and then 12. So, altogether it should be 100. So, this is 41 plus 15, 56, 71, 88 and 100. And if suppose their individual returns are computed out to be 13.5. So, this is in the percent. Similarly, this is also in percent, 13.5, 12, 6.5, then 6 and 7.5 and 7. So, this is suppose their individual returns of the asset. In that case, the RIWI, if you calculate, if you if you multiply, so it will be in percentage. So, if you take in terms of decimal, it will be 0.0311. Similarly, it will be 0.0216. This will be 0.00975. This will be 0.009. This will be 0.01275 and this will be 0.0084. So, RIWI is calculated, and if you have to calculate the portfolio return, then portfolio return will be summation of the RIWI, and if you sum them, it is coming as 0.0926. So, portfolio return you can say that it will be 9.26%. So, that is way the way you calculate these portfolio return. Now, many a times you are you have to find the change in value of these the original value to find the estimated rate of return when the change of value is there from 1 year to another year. So, in that case if you find the portfolio rate of return, so that will be calculated by RP will be VP2 minus VP1 divided by VP1. So, this will be your market value of the entire portfolio at the start of the year, and suppose the market value at the end of the year is VP2. So, in that case what will be the rate of return. So, that can be calculated based on that. So, suppose you calculated this, you had the value calculated for certain situations. Suppose you have certain points, and then that increase to and the value was increased to some value. So, you can have this use this formula, and you can get these rate of return for the portfolio, how it has grown up or so. So, that way from the year end, first year's in any year when it started and when it ended, that rate of return can also be calculated. Now, what we further try to understand is about the portfolio risk. Now, what is this portfolio risk? So, what we see that portfolio return and portfolio risk, what we have seen that portfolio return is a summation of the weighted individual returns of its component assets. That is what we have understood in that case. And now, we try to have the definition about the portfolio risk. Now, if you talk to portfolio risk, it is it can be reduced by adding more and different assets. Now, when we talk about the risk, then what happens that if suppose you have different components, you have if there is diversification of the portfolio. Now, what happens that when they are correlated, in that case the correlation among them becomes important. So, for that you find the correlation coefficient, how that return rate of return for the all these components are coming up. Suppose if one is increasing, another is also increasing, that is basically positive correlation. Similarly, if one is increasing, another is decreasing, in that case it is the negative correlation. Now, if it is very positively correlated, that is not a very favorable case, because that may lead to, so the suppose there is loss, in that case it will be accumulation of loss. So, what we see that it should not be very highly positively correlated. So in the case of the quantization of the portfolio risk, we need to study also about the correlation among the variables. So, we will see that how that can be studied. So, as we discussed that degree of correlation among the individual assets in a portfolio is important. Less correlated the assets, the less will be the portfolio risk. So, basically when we are talking about the different assets in the portfolio, and if their correlation coefficient is -1, they are completely negatively correlated. So, in that case they basically reduce the risk, but if they are very highly correlated, positively correlated, in that case there will be chances of risk, quite a high risky situation may come into, and we will see that how that such situations are basically understood, that when there are chances of less risk or high risk. So, how you see those components. So, if you look at the case of portfolio risk, that can be understood by looking at one example. Now, that can be understood by looking at the two pair of assets, you have x and y. So, if for asset x and y you have the values given, and based on that you can say, you can calculate the correlation among them, and then you can say that whether there is a chance of less risk or high risk. So, suppose you have asset x and you have asset y. Now, for the asset x, suppose the values are like you have so for k1, k2, k3, k4 and k5. Now, in this case their probabilities are assigned. So, probabilities are like 20%, 15%, then 25%, 18% and 22%. So, that is your PRI. Then for that you will find the value of KE, and also before that you have the values of KI. So, KI values which you are getting is minus 1 point minus 0.12, similarly it is 0.405, then it is minus of 0.707, and similarly you have another value as 0.38 and you have 0.18. So, if you add is 56 and minus 7 is 49, and then so based on that you will be getting the so if you add them and based on that you will be getting the KE. So, expected value. So, that will be KEX. So, KIX will be these values, that is the return which you get, and what you get is if you add them. So, 56 and 49 plus so that way 99, and then so that way you are further you are subtracting this and divided by 5. So, it is coming out to be 0.155. So, this will be then you have all these values will be coming as 0.155. Now, what you calculate is the Ki minus Ke. So, that will be your these values. So, that once you calculate it will be minus of 0.275, then it will be minus of, so this will be 0.25, then it will be minus of 0.225, this will be minus, so this will be 0.225 and this will be 0.025. Now, the purpose is that you have to find the correlation, and for that you want to find the covariance, and once you find the covariance, then the correlation can be found by covariance divided by some of the standard deviation. So, covariance of the xy you have to find. Now, for that you have to have the the formula Now, for that we will for this also you will find the Ki minus Kex. So, this is the way to find the dispersion basically or standard deviation formula. So, this will be square into PR. So, if you calculate that, it will be 0.015, this will be 0.0094, this is 0.0126, this is 0.0091 and this is 0.00014. So, this summation comes out to be 0.046. Now, this is for asset X, and then the main aim is to find the correlation, and for finding the correlation actually the formula which will be used will. So, first of all you will find the covariance xy, and covariance xy basically will be found by summation of I equal to 1 to 5. This will be Kix minus Kiy, and then it will be further Kiy minus so this will be Kix minus Kex and then Kiy minus Key, and then it will be multiplied with Pri. So, this way you are going to have the covariance, and then you will find the correlation between xy, and correlation between xy will be covariance xy divided by sigma x sigma y. So, we have to first find the sigma x and sigma y. So, once you have the returns given, then this is how you find the sigma x square and sigma y square. So, sigma x square will be Ki minus Kex square PR, its summation. So, you are getting the sigma x square as this summation, that is your 0.046. Now, so you will similarly find the sigma y square, and sigma y square. For that you need the data. Now, this is for the asset X. Now, you need to find for asset Y. Now, for asset Y again you had the similar assets K1, K2, K3, K4, K5, and in that you have the PRI, that is for asset Y will be have the PRI as point So, that is Kiy is given for here, and Kiy is given as minus of 0.15. Then you have the values like 0.50, and then you have a minus of 0.08. So, this is minus 0.08. This is second, this is first, this is second, this is third. Then you have next value is 0.45, and then you have 0.15. Now, if you look at these returns, you can see a trend. Now, this Kix is minus 0.12, then it is minus 0.15, it has increased to 0.40, it has also increased to 0.50. Then it has the decreased value of minus 0.07, it is minus 0.08. This is 0.38, 0.45, 0.18, 0.15. Whenever it is increasing, this is also increasing. Whenever this is decreasing, this is also decreasing. Now, by looking roughly, you can have a sense that how they are correlated. If one is increasing, another is also increasing, one is decreasing, another is also decreasing. So, there is high correlation among them, but then you have to find these values. So, for Key, again you will be getting the K. So, for this is Kiy, then you will be getting the Key, and further you are going to get the Ki minus Ke square and all that dot PR. So, ultimately for this, if you are getting this value is coming out to be 0.0554. So, that can be calculated because you will have Key as the, if you have to sum it. So, it will be 60 plus 50 110 minus 23. So, it will be 87, that will be divided by 5. So, it will be basically 0.174 will be the Key. So, 0.174, then you can further you can calculate all these values like Ki minus Ke, then Ki minus Ke square into PR. So, PR is all you know known. So that way you can have these values, you will be having the values like point. So, you will have Ki minus Kiy minus Key and that you know into Pri. So, you know that value can be calculated, and then what you do is you calculate these covariance. So, basically when you calculate the covariance, this value this 0. You know this sum is basically coming out to be 0.067. So, this will be Ki minus Ke square into Pri. So, these values will be coming as 0.021, 0.016, 0.016, 0.014 and 0.00013. So, you sum them 0.067 it is coming, and this is 0.046 is coming. So, sigma x square will be 0.046 and sigma y square will be coming as 0.067. Now, based on that you can find the covariance. Now, covariance will be you know Ki y minus Ki x minus Kex into Ki y minus Key into Pr. So, its summation Pri. So, that will be giving you the covariance, and that will be coming as 0.0554. And if you find the correlation will be 0.0554 divided by sigma x square into you know sigma y square under root. So, it is sigma x into sigma y. So, if you find these values, it is coming out to be 99.9% correlated. So, the thing is that such situations are giving you risk, because in one case when the return is giving more, this is also giving return more, but when this is giving return less, it is also giving return less. So, they are basically these assets are very positively correlated. So, we try to have a situation where they should be negatively correlated, not positively correlated, so that if there is a risk in if there is loss in one case, then that can be compensated by the gain in the other case. So, that may be situation, you know that situation can be understood, because that can have another example that you know we can see in our coming lectures, where we will see that the return which you are getting for the x and for y, they are different. When this is increasing, then this is not increasing, this is actually decreasing. So, suppose minus 0.12 to 0.140, when it is going to 0.40, it is coming from 0.15 to suppose 0.05. So, like that when it is there, so when it is increasing, this is decreasing, that will have, or when this is decreasing, this is increasing. So, that will give you a negative type of correlation, and that will be giving you the minimum type of risk. So, such you know correlation coefficient value when you calculate, that basically you know gives you the value of the you know portfolio risk, and that analysis is required to ensure that you have minimum of the risk when you invest you know for the manager of the you know portfolio who is managing all that you know investment you know assets. So, these point needs to be understood, and these points needs to be you know kept in mind. Thank you very much.